Good morning, everyone. Thank you for joining us today, and I hope you managed to find your way through Teams okay to join us and you can see the screen in front of you. By way of introductions, I'm Josh Levy, Chief Executive of Ultimate Finance, and I'm delighted to be joined this morning by Andy Ribbins, who many of you will know, Managing Director for Asset Finance and our Group Sales Director. We've got a range of topics that we want to cover on this call, but the key theme, and you've got it on the title page there, broker support, the key themes working together during these challenging times. And let's not forget that whilst all of the focus has rightly been on the struggles of small businesses, the recent months have been far from plain sailing for lenders and brokers too. We've had to learn as many new acronyms as the government could dream up: CJRS, CBILS, BBILS, CLBILS, and I'm sure many more, whilst also adjusting to remote working setups. Although pleasingly, I've been able to convert Andy to the digital world, which is great news. And at the same time, we've obviously been dealing with a quite extraordinary wave of payment holiday requests, as well as seeing new business volumes and therefore income decrease. So all in all, it's been quite a few months, I think it's fair to say. The key message from Andy and I to all of you today and through this webinar is really just thank you for your support. And likewise, we hope you and our mutual clients value the support we've been able to give over the past 3 months. We very much consider you to be our partners, and we hope that feeling is reciprocal, and we'll always look to approach our business interactions in that spirit from today and obviously going forward. Our brand promise as Ultimate Finance is all about keeping business moving, and that could not be more appropriate as we look to move from the hibernation phase through to the recovery phase of this crisis and beyond. So as an agenda for the next 30 minutes or so, we'll go through the ways in which we can continue to work together to support our clients. We'll introduce you to our newly expanded CBILS accreditation credentials, which now includes asset finance. Andy will share his insights from the front line on the short and medium term outlook for the asset finance market. And then we'll also talk through some lessons from the first wave of payment holidays that's partly informed the process we're putting in place to manage any likely requests that come for additional forbearance as we approach the end of June. For those that have joined these webinars before, you'll be familiar, but there's a Q&A box on the right hand side of the page. So please do write in there if you have anything you wish to ask, and we'll look to provide answers at the end of the presentation or follow up directly with you guys afterwards. And before we get into kind of the main purpose of the webinar, I just thought it'd be worth explaining for those who aren't as familiar with us, who we are and how we fit into the Tavistock Group. Ultimate Finance, we've been providing funding to SMEs for nearly 20 years. It's really been the last 5 years where the development has accelerated to create what we have now, which is a truly national multi-asset lender with a combined loan book of over £265 million across our 3 specialist areas of working capital finance, asset finance and bridging finance. As we've grown and experienced the many inevitable growing pains along the way, we've really sought to build our business around what our customers and our introducers require and value most. We believe this to be speed, clarity of approach, the best technology tools, and just making sure we're showing flexibility throughout when considering everything from single asset deals all the way through to kind of multi-asset structured finance solutions that can combine our product lines. And every week we try and take steps to ensure we're being more than just a transactional lender, we're being a relationship-based lender, but clearly being able to deliver at the transactional level is an important part of our service. And this ethos comes in part from our heritage and our ownership structure, and this is where Tavistock comes in. So Tavistock is a truly unique shareholder. It's a global family office investment group started and owned by entrepreneur Joe Lewis, many of you will be familiar with. Tavistock owns 200 companies worldwide, mainly across the UK, US, Australia, Mexico and the Bahamas. And across the portfolio, there's maybe a handful of businesses that have been positively impacted by COVID-19 dynamics, but the rest have experienced varying degrees of pain. And I say this really as a demonstration of how this crisis has taken an indiscriminate hit to businesses of all shapes, sizes and sectors. Tavistock and Joe are probably best known here for owning Tottenham and leading the redevelopment of what I completely unbiasedly say is the best stadium in Europe. It's great, clearly, to have a stadium capacity of 60,000 when only 300 people are allowed to watch games at the moment. But maybe that's a subject for a different webinar at a later date. And the other large investment in the UK you see on screen here under sport and leisure is Mitchells and Butlers. So again, 1,800 closed pubs and restaurants. So please do drink irresponsibly when they open again in July. So then coming on to the crux of this, working together to support our clients. As an industry, probably the best place to start. I do believe the response to this crisis has been both appropriate and balanced, and probably most importantly, pretty consistent across the market, which quite clearly has not always been the case historically. And just to demonstrate what I've been saying about our support channels in an asset finance context, it broadly breaks down into two categories here. The first being proactive, which is where our CBILS accreditation fits in, and the second being reactive. And over the past 3 months or 2 months or so, we've provided payment holidays to 457 clients across over 500 agreements. This adds up to over 20 million of agreements with some form of payment holiday. We're not a bank, obviously. We have no support from our funders or government, no particular support, I should say. And so clearly, any payment reschedule has to be strongly justified for us. It has been, and Andy will talk a bit more about this later, it has been encouraging to see a number of clients that we did give payment arrangements to have recently requested to be returned to normal payments. And that I think is starting to filter through, which is good news. And in addition to the payment reschedules itself, we've also had to deal with over 300 cancelled direct debit instructions, which is very frustrating and not the best approach for any business to take. And so the key message for all of us to be delivering is that please ask for support if needed. Taking isolated actions like cancelling direct debit mandates is not the best approach. So then we come on to CBILS. I'm sure none of you have been living under a rock for the last 3 months, so you'll be well aware of what CBILS is. Last week we were very pleased to be able to announce that we've been formally accredited by the British Business Bank as an approved lender for asset finance. This adds to our existing accreditation for term loans to new and existing Invoice Finance clients. So for asset, we expect to be in a position to go live with our offering this week. We're targeting Wednesday for our official go live, but we'll obviously keep you fully updated as and when that is firmed up. And as you know, the scheme supports lending of up to £5 million to SMEs across a range of product types. So far, it's mainly been used for simple term loans delivered by the high street banks, but that dynamic is shifting. The way it works is giving a government guarantee to lenders of 80% on outstanding loan balances post the proceeds of any recovery process. So again, it's very much a loan, not grant, and the borrower remains fully liable for repaying the loan. Big feature of the scheme is obviously access to fee-free lending with interest payments covered by the government for the first 12 months. As a lender, we pay a scheme access fee, which is a percentage on every new loan provided with the guarantee. And again, you'll all be familiar with this, but this slide just highlights the key differences between the bounce back loan scheme released 3 to 4 weeks ago now and CBILS. So borrowers can only have one or the other, although they can move between the two if funding requirements become larger than what can be generated under the bounce back scheme, for example. Importantly, when it comes to asset finance, a business can take more than one CBILS facility as long as the total adds up to less than 5 million. And the scheme is currently open until September, but it wouldn't be the biggest surprise in the world for it to be extended. So there's clearly time to add to any initial loans obtained. And then finally, just a quick look at the scale of the government funding scheme so far. So the dark blue represents bounce back loans, the light blue represents CBILS. As of the end of May, £21 billion of bounce back loans have been provided to 700,000 businesses at an average loan of about £30,000. And for CBILS, the light blue, £8.5 billion have been provided at the end of May to 44,000 businesses with an average loan of around £200,000. So that's the different dynamics between the two. And all of this adds up to quite incredible levels of support to an SME community, in some instances, traditionally reluctant to use external finance. We'll talk in more detail about the details of our asset finance offering shortly, but for those of you that have clients interested or requiring working capital facilities via Invoice Finance. Our overall accreditation allows us to provide term loans of up to £500,000 alongside an Invoice Finance facility of up to 5 million, and obviously the additional 1 million of asset finance, which we'll talk about. And for more information on our Invoice Finance or term loan accreditation, there's plenty of detail on our website. And also you can speak to your usual sales contact after this. So just then on to our features of our asset finance accreditation. It's largely an extension of our existing non-CBILS offering, so it covers all product types across hire purchase, leasing and refinancing. We'll be offering CBILS asset finance between £10,000 and £1 million for terms of between 1 and 5 years. There is a maximum lend per single asset of £500,000, and again the borrower benefits from no fees or interest in the first 12 months. As per our normal approach, we lend against hard assets only, and we'll come on to specific criteria shortly. From a process perspective, we've designed our process to really prioritise speed and efficiency at all stages, whilst making sure we're meeting our requirements under the BBB terms we've signed up to. And so the process we've got incorporates our improved online application portal, our Nevo app that many of you will be familiar with for identity verification and now open banking, and also e-sign for the very first time. So what we have is the most technology-enabled new business journey we've put to market so far, and I'm excited to hear feedback on what works well, and also importantly where we can continue to improve on this. So just a flick through qualifying criteria for the scheme. This is a combination really of BBB rules, our internal criteria, and also our interpretation of the BBB rules, which is down to the lender discretion in some areas. So starting from the top, we'll only be lending to UK limited companies with a turnover across the group of less than £45 million. Eligible purposes of the CBILS loan are anything that provides an economic benefit to the business, and really that covers 3 broad areas, which does cover a lot, but it's working capital, investment and refinancing. The business needs to self-certify that they've been negatively impacted by COVID-19, and as a lender we'll need to validate this, but clearly nearly every business has been negatively impacted over the last few months. We just need to understand how and why. Viability, you'd have heard this from other lenders, it's a key concept within the rules. We'll be judging this on whether the business was profitable at the EBITDA level as at the end of 2019. We will look to adjust potentially for dividends that form part of normal remuneration practices. And then the BBB rule around business undertaken in difficulty. This is essentially an accumulated losses test relative to share capital, and the business can't have been insolvent at the end of 2019. The business must be able to produce filed accounts and also recent MI, and will judge affordability as a minimum of 1.15 times 2019 EBITDA cover against ongoing debt servicing requirements. Again, we'll look to adjust EBITDA for dividends, but importantly, we will allow the benefit of the new asset purchase to be included in the figures. And on the same point, understanding that economic benefit of the facility is key, and we have to go through a process of determining the maximum loan size available under the scheme, and that's really limited by 3 things here: turnover, wage bill, but in most cases here it's most likely to be self-certification around liquidity requirements over the next 18 months. And again, we talked about we'll only fund hard assets, but important to draw out, we are not able under the scheme to finance vehicles that are subject to personal tax. They're not eligible under the scheme, and likewise VAT deferral facilities are not included within the scheme either. And then the final 2 points: the business must have no history of financial crime or fraud, and also have been clear of HMRC pressure pre-crisis. And then just final one from me. I'm sure you've appreciated and experienced with funders during the past few months that there's been numerous challenges managing the combination of remote working adoption, payment holiday requests and new business volumes. As I mentioned earlier, we've sought to learn through this. We've designed our process to prioritise speed and efficiency, but also to make sure that you as the broker is fully informed throughout. So the way we do this, all applications must be submitted through our online broker application portal, many of you which have had access to this and been using for the last year. This allows us really to capture the necessary information to consider the application, but you'll also be able to use the portal to share documents and get status updates on the application. So once the application's in via the portal, it's then directed to your sales contact for analysis and consideration of the proposal. And then as part of our process, we'll be extending the use of our market-leading digital ID verification tool to also include open banking functionality. So again, with the click of a few buttons, all ID&V and banking information provision and verification is provided through our Nevo app. It's a great tool. It really does play to our core focus here on speed and efficiency. And again, to deliver results and funding at speed and at volume, we're introducing on all deals less than £250,000 for the first time our e-sign capabilities for the enlarged suite of documents that we're required to have clients sign up to under the scheme. And again, as we begin working on applications together from this week, please do not hesitate to share your feedback, positive or negative, about the experiences you or your clients have had with working with us through this. We've tried to put in place a process that gets it right as quickly as possible, but we do recognise there is always room for improvement, so please do let us know your thoughts. And then I'll now hand over to Andy to take you through our information requirements and process in more detail.
Thank you, Josh, and good morning to everyone. Our CBILS offering, or the CBILS offering, is designed very much to turn the clock back to pre-COVID. Basically, if a proposal would have been acceptable prior to this extraordinary event, the idea is it will be acceptable now, providing any negative differences have been as a consequence of the pandemic. From a customer's point of view, all that will have changed are the removal of the necessity to provide personal guarantees under 250,000, plus an interest and fee-free first 12 months. I say all, but these are very significant benefits to the customer that run alongside the ability to fund an asset where, due to the ravages of COVID, they would not have been able to do so at this time. Josh has already touched on the information we're going to need. Much of it is similar to what we've requested in the past for a standard deal. On top of what we'd normally look for, the key ones on this screen here are the explanation and self-certification of the negative COVID-19 impact. It is self-certification, but it is highly important that we get that information through to be able to make the justification to use CBILS. We are asking for a summary of the business plan. That is not going to be a requirement of a 5-10 page business plan. It really is probably 2 or 3 paragraphs of just explaining why the purchase of this particular asset is going to help the business going forward. It really is going to be quite straightforward. As Josh said, all the proposals will be routed via our broker portal, which we believe will provide you the best possible service. It also enables us to provide British Business Bank with the reports they require to satisfy our reporting obligations. So it is mandatory that everything is routed through the portal. For those not yet registered for the access to the portal, the process is simple, quick and painless, and our broker desk will be on hand to guide you through this. If we just move on to the next one, please, Josh. The security we're going to require is pretty much as normal. The primary security is going to be the asset that's caught under the agreement. Instead of taking personal guarantees for anything below 250,000, we will be looking for deliver up indemnities, and they will be mandatory. We've had instances where the goods come back and they've been cannibalized, or they just don't come back at all. We're going to have an issue. So as long as we get the goods back at the end of the day and they've been treated properly, we're going to be fine with that. Be clear that the company is responsible for the debt first and foremost. So in the event of default, it will be the goods that will be taken back, sold, and then the company will be responsible for any remaining debt. The CBILS guarantee only covers 80% of the post-recovery loss. Commissions are going to be similar to, in fact, exactly the same as what we're offering at the moment, and we're trying to keep the product as close as possible to what we've done in the past. We will be looking as a company as a usual minimum net yield of 10% across the board, but we do have the ability, as always, to blend. So if we have 2 or 3 deals, as long as overall it comes out at our minimum net yield, we'll be fine with that. Again, if we can move on, please, Josh. The sign-up process is quite simple. These slides will be shared with you afterwards, and you'll see on there you have the broker portal access. Just click on there, you can register, and we'll have you set up in no time whatsoever. Right, I'd just like to have a little chat about how we've seen the market in the past few weeks. Very encouragingly, over the last 2 weeks, we've seen the level of proposals return to pre-COVID-19 levels. Over 50% of those proposals have been for commercial vehicles. The balance spread across construction, agriculture, recycling and manufacturing. There's been a notable boom in proposals, and I guess you guys have probably seen a lot of this, where we've had requests for small delivery and courier businesses. We are being very, very cautious in this area because many of them are similar profile to newish start ventures, mainly wishing to increase the fleet size on the upsurge on online shopping. Most of these companies are showing bank statements with sizable increases in income, which is down probably to Mr. Amazon. But many of these applicants are non-homeowners, they're non-UK residents, and whilst they may be doing particularly well at the moment and the bubble may not burst entirely, it will certainly deflate at some point. So that is an area we're being very, very cautious of. Other areas that we're being cautious of are obviously anything to do with the bus and coach industry. In line with our peers' experience, we have found 60% of our book have requested payment holidays. Encouraging 40% haven't, but we are looking obviously very, very closely at bus and coach. It's a complete no-go at the moment for anything to do with hospitality and the events industry, and the same can be said for short-term car hire. We are, however, very much open for business, and taking what I believe is a pragmatic stance on underwriting, the CBILS offering will only enhance our ability to continue to support SMEs. Which takes me on to the sort of support we've been offering through COVID. So through March, we had March through to June, we had 675 requests for payment holidays, 80% of which came in March, which was horrendous for all of us. We approved 74% of these requests, which gave us over 500 payment holidays. I would say almost without exception, everyone that applied for a payment holiday was looking for 3 months as a minimum with no payment whatsoever. We spent a lot of time and effort actually speaking to the customers to see what they really needed, and the response was really very, very very positive. Of those approved, we only had to actually give 14% on full payment holidays, 18% took interest only, and 68% actually took 50% payment holidays. That was really rather encouraging for us. The worst hit industries on our book, and it's not going to surprise anyone, bus and coach, 60% of our customers had holidays, hospitality and events 90%, and actually short-term car hire was 100%. So all of those areas are ones that I've already said we're being very cautious of. We faced some very interesting issues throughout Wave 1. The most frustrating as a consequence of the government messaging, which, to be clear, I don't blame them for. It was just the message that was picked up by people in general. The compulsory provision of payment holidays for mortgages and regulated finance agreements suddenly morphed into compulsory payment holidays for a good many of our customers, at least in their minds. It was an oft expressed view that it's my right and your duty to provide a payment holiday. Quite frankly, it wasn't, but we did the best we could. In fairness, customers generally thought we were getting government support to provide relief, when the truth of the matter was revealed to them that the vast majority were understanding and generally grateful for whatever support we could provide. And I thank you to the brokers for the support you gave us in sorting an awful lot of this issue out. A further frustration has been the not wanting to take CBILS or bounce back loans in order to avoid increasing debt, instead relying on the finance companies to support them with payment holidays. So as an example, I spoke last week to a customer who made it quite clear to me that he was aware of his ability to take a bounce back loan, but he didn't want to increase his debt. He would much rather rely on the goodwill of the finance companies to continue supporting him with payment holidays. And quite frankly, that isn't something that we're going to be able to continue doing. And that's not just talking from an ultimate point of view, but from talking to a number of our colleagues in the industry too. The same can be said to an extent of people or companies supporting one's own business using either company resources or the personal resources to keep the company going. Another example we had of this was a company insisting that they were going to keep a minimum of £100,000 credit balance in their account and would not dip beneath that, and instead would take payment holidays from the finance industry. Again, we've had to go along with it, but coming up to what we're going to refer as wave 2, we frankly can't continue to do that. So these issues have to an extent influenced our thinking as regards to what we're terming as wave 2. There has been some good news with customers contacting us asking to return to normal payments. However, we are preparing ourselves for the worst but hoping for the best. The initial signs have been good, and I've got everything crossed at the moment when I say that. We have communicated directly with all of those customers taking payment holidays to confirm that normal payments will resume in July. To date, we've had very few requests for extensions, the notable exception being the bus and coach industry, which I've said already we will view in a different light as a whole. We have set in place a process which we consider which will consider the necessity, suitability and appropriateness of further forbearance. Our stance, I believe, will be firm but fair. Areas of consideration in agreeing or declining any further forbearance will be, first question will be, is the asset a business critical asset? If it's not there to support the business, quite frankly, we're not going to be able to support that asset either going forward. Your director's very smart Range Rover isn't going to generate income for the business, and we're not going to be able to support an extension on that sort of equipment or vehicle. We'll be looking at the track record of companies and how they behaved and performed during the existing payment holiday. If they manage to keep their payments up to date, then again we'll look at supporting them. If it is a vehicle, we're going to request or insist that it is sworn off, that a sworn off road notification has been completed. Our view being that if the vehicle is not sworn off road, it's being used for the business to generate income, and that income ought to be used to help service our debt. We're going to be insisting that the asset is insured and that we have proof of that. And we are going to be saying to customers that we do expect them to have taken the government support where they can. Going back to my earlier point of the customer who didn't want to take a business bounce back loan and rather rely on the finance industry, we just can't continue to do that. And we are going to be looking for them to have taken whatever support they can. And the same being true of the directors, owners of the company, we are going to be looking for them to have supported the business. And that can be by way of an injection of cash themselves, taking lower wages, taking lower dividends, giving personal guarantees. As long as we can see that the directors, owners are invested in the business, then we will continue to assist ourselves. Of course, the business has to continue to be viable, and we will be able to check that through looking at the bank statements where we're going to access via open banking. This is going to be a mandatory requirement. It is quick, it is easy, and it gives us good, up-to-date, accurate information. In wave 1, we were caught rather out and we didn't have the ability to charge interest on any payment holidays. Our plan for wave 2 is that we will agree a flat fee to cover the administration, which is quite considerable, and the interest cost of deferring payments. Where I've said the business has to be viable, we will take into account the business sector with regards to making that decision. And people like the hotel, the events and the bus and coach industry, we're fully expecting to have to support a little bit longer, probably into the start of next year. We will look to verify assets, but we're not going to be sending people out to do proper asset inspections. We'll simply be able to do that over the connections such as Zoom and Teams. Josh mentioned earlier on that we had 300 plus direct debits cancelled. We're not going to be able to work with customers that are going to cancel the direct debits on us. Any payment holiday will be subject to them signing a new direct debit or continuing payments on direct debits, and they will have to continue to keep their payments up to date throughout the holiday period. Otherwise, we will have to look, unfortunately, to take action to recover. I believe what we've put in place will be in line with most people in the industry, and I do believe genuinely that it is, whilst being firm, is a fair stance for us to take.
Thank you, Andy. So just a few concluding remarks from me, and then we'll come on to questions. We're all aware the economic outlook is tough. It will remain so. But as a lender, we're well positioned with a clear appetite and, importantly, strong funding lines to continue supporting you and your clients through the recovery. For new business, we can offer three things on screen here. So asset finance, which you just talked about, term loans alongside an invoice finance facility, and also a structured finance solution, which can potentially be a combination of all three parts of our offer. And on top of this, we clearly have our non-CBILS offering too, which includes property bridging. Our proposition really centres around our core service strength, which hopefully at least some of you recognise, and this is where the power and value of our team working in conjunction with our brokers combined with our technology comes really to work for the benefit of the clients to provide the support they need, whether that's funding or anything else. So with that, I will just flick on some questions that people have been asking, and Andy, you'll want to answer some of them. So the first one, if a business has already taken a bounce back loan, can they access a CBILS asset finance facility? So you cannot have the two facilities at the same time. So what you can do is refinance away from a bounce back loan onto a CBILS facility, but only if the CBILS facility clears the bounce back loan. So you can never have both at the same time. And Andy, this one for you. So where we've got an existing application, can it be switched to the CBILS version, or would we need to start again?
No, absolutely. If you're already in the system, we're happy to look at it on a CBILS basis. In fact, we've already set the underwriters up to do so. So they will be looking proactively at any deals that are coming in as soon as we get the green light from BBB.
Excellent. And can all introducers put in applications? Yes. So we are not being fixated on having a small pool of brokers. It's any broker that is registered as an introducer with Ultimate Finance. So if you currently have an agreement with us, then you have nothing to do. If you do not, then part of this will provide details on how to register, and as part of the registration you'll get given access to the broker application portal. And Andy, a question for you on the deliver up indemnity, just to make sure that everyone understands what it is and how it works.
Yep, sure. So we're quite clear as to what a personal guarantee is, that you get a person be personally liable for the debt or any shortfall on the debt come what may. Excuse me. With the deliver up warranty, it is literally what it says, providing you deliver up at the end of the agreement or at the period that the agreement is terminated, you deliver up the asset in workable condition, or condition that is consummate with its age, then there is no further liability to you. So we're really just covering people that are going to either abuse, cannibalise a piece of equipment, or sell it elsewhere, or hide it, or some other way prevent us from getting our asset back. So providing a director who is given the guarantee is being honourable, then there is no issue for them whatsoever.
Great. So question around open banking and whether this is to do with Cato data sharing, Cato being current account turnover. So no, it's not to do with that. So for us, open banking really is just a quick and easy way to share banking information. The reason we're enforcing it as mandatory in this process is because one of our obligations as an accredited lender is to confirm what we just talked about, that that business has not also got a bounce back loan as well as a CBILS facility. Open banking, we get access and it's there for 90 days unless the business cancels the access, which they're able to do at any time. It really enables us pre-payout to just confirm that they haven't taken any further support that would contravene the criteria or the rules around the CBILS scheme. The other thing it enables us to do, because we're assessing viability pre-crisis, clearly we want to see the financial state of the business through the bank account or the banking information prior to kind of revenue streams shutting down from March. So that's really the importance of open banking for us. I'm happy to answer specific questions on that because we think we've got a good proposition there with the way it works. And Andy, on commission payments, is it to be paid once the deal is live, or will there be a delay due to delays in the government paying fees?
No, it will be paid as per normal. It will be paid out at the same time that we pay the deal out.
Yeah. So I think, as Andy said before, we're trying to replicate as much as possible the existing process that really works well, and we're certainly not looking to change any commission arrangements or mechanics as part of this. A question you'll probably be best answering this one, Andy, around whether bounce back loans are being used to repay asset finance agreements and the impact they may have across the industry, but also with us around triggering commission clawbacks to brokers.
We haven't had any evidence so far of people using bounce back loans to settle finance off on the basis that our agreements are fixed rate, fixed term agreements. I would suggest we're probably going to be one of the last type of agreements they're going to want to use the funds to pay us off. So yeah, so far it's early days. I think the biggest effect of bounce back will be deals that are in the pipeline that don't actually get written because it's cheaper and easier for a customer to go and get the funds elsewhere. But once used, then they, it's a once only shot for them. They will then have to come back for hire purchase or leasing with us.
And on triggering commission clawbacks?
Well, the commission clawbacks only happen under the normal circumstances of if we don't get a standard settlement figure, then there'd be a potential for a clawback. But generally speaking, we get the standard settlement figure and therefore there is no clawback. And
for us, it's within the first 12 months.
It's within the first 12 months, yeah.
Yeah. So, I mean, personal view is we have seen bounce back loans and CBILS actually being used to repay some of our invoice finance facilities, or at least paid down. I have to say it does feel short-sighted. I guess the advice to businesses should be, if you can access some of these schemes, you should take it, particularly in the first 12 months where there's interest-free and some capital holidays. Take it as additional working capital buffer and use it there rather than repaying existing finance facilities. It's worth having the extra liquidity at this sort of time. And Andy, on vehicle SORM, could not do this if the vehicle's parked on the street, would we need to arrange to have the vehicle garaged if it's been registered off road?
Absolutely, yes. Yep, they have to comply with all regulations.
Excellent. So again, just one more question on whether bounce back loans and CBILS can be used together. So the answer is no. So there's a lot of dialogue going on between lenders and BBB, particularly around asset finance facilities, where there clearly is a different justification for taking a bounce back loan and taking a hire purchase facility or whatever it may be. But at this present time, the advice we're given and the guidance we've been given quite clearly from BBB is that you cannot have both. Will we consider soft assets? No. So our lending criteria is hard assets only. Mike has asked, are you still doing own book lending? So we only do own book lending. We do not broker anything out. Everything we take is on our own book. Can you fund a customer who has had a CBILS loan for a CBILS asset-backed lend? I'm not sure what that means, Mike. If you don't mind just dropping another question, we can see what specifically you want to find out there.
I suspect, Josh, there, if it's within the £5 million, then yes, we'll be able to get the CBILS loan, but it has to be within that limit. Yeah,
so you can take multiple CBILS facilities. A client can take multiple CBILS facilities up to that 5 million. Additional criteria to taking a CBILS alongside an ID facility. So there's some of the information on our website. We'll make sure we send out our Invoice Finance criteria alongside this. As I said, we can provide multiple CBILS facilities. It can be a CBILS asset finance facility and a CBILS term loan, but we'll only provide CBILS term loans where we've got the Invoice Finance facility with it. So the Invoice Finance isn't itself covered by CBILS, but it does enable us to then provide the term loan alongside. So anyone for you on the bus and coach sector? Is there anything we would look at, or is it a blanket no at this time?
No, on the basis that 40% of our book are didn't ask for payment holidays, and some of them have actually done quite well through the period. We will look at every single proposal on its own merits. It's the only place I would say it's absolute no at the moment are for the courier vans, at the events industry, and for short-term car hire. But we would look at bus and coach, but we look at them cautiously.
Yeah. Question on security. So PG is required for CBILS asset finance. So under the scheme, personal guarantees are not able to be taken for any facility less than £250,000. For anything above £250,000, we will assess on a case-by-case basis, but it's likely that a PG would be required. But again, only over £250,000 as a facility. Question from Nigel about how the limit of 5 million conflicts with the single loan limit of 500,000. So this is where I'm just putting to separate the scheme rules. So under the scheme as a whole, an SME can take up to £5 million of CBILS facilities. Under our asset finance accreditation, we're only able to provide £500,000 against a single asset. We can provide £1 million to that SME under asset finance agreements where it's multiple assets being financed. And Louise has asked, on the portal, will we need to specify this as a CBILS application, or will you look at them all and decide this yourselves? So Louise, on the portal, there is the option right at the start to define it as a CBILS application. Again, if it comes in as a CBILS application and for whatever reason it doesn't meet the scheme criteria, then we have the option, obviously, to revert it back to a normal asset finance facility. Question from Matt around increased initial prepayments for Invoice Finance. So Matt, again, on Invoice Finance, it's covered slightly separately, and there's a lot more information on our website. The support mechanisms we are providing for existing clients are around temporary increases to prepayment levels, and also potentially increasing recourse periods, just to provide additional support through this. Question from Tony about CBILS and bridging. So this is something we are working with BBB on to see if we can offer property-backed loans via the CBILS scheme. We hope to have some news on this in the next few weeks, and you'll obviously be informed, Tony, as well as everyone else. Question, Andy, will we reconsider clients who have been declined previously on standard terms?
Yes, short answer.
And how will we do this?
Right, the easiest thing to do is to resubmit the proposal via the portal, or if you wish, if it's not if it was declined quite recently, is just simply have a word with your designated RD, regional director, have a word with them and ask him to lift the deal up to the underwriter's attention again for you.
Question on paperwork, whether it's different and will it be raised by us or through the portal. So there are additional documentation that has to be completed and signed as part of the scheme. So things around the business interruption payment that will enable the client not to have to pay interest for the first 12 months. All of our documents are raised by the system, so it's all automatically generated. It all comes through the portal and sent to you and the client for electronic signature. So there are more documents. It's not something we want. It's just a function of the scheme itself. Could they have a funding circle loan as well as an ultimate CBILS facility? The answer is yes, in theory. Again, because our CBILS facility is used for a different purpose, so it's around the financing or refinancing of an asset, and we take security there. It's theoretically possible for the two to be considered at one. Again, that's underwriter discretion for us. Will we consider refinance? Yes, we will. Again, refinance is part of what we do in the ordinary course of business, and it's part of our accreditation here. Andy, how quick do we expect turnaround times to be, and how often do you need to touch metal for CBILS asset finance?
Turnaround time will be, we're still aiming to turn everything around to a decision within 24 hours of it being with the underwriters. And as to actually touching the metal, it's only going to be on assets over £100,000. But with the COVID restrictions still in place. Whilst they are in place, we will and do have measures in place to make things a little easier. So we will accept an inspection via Zoom or Teams, and we've got a process for doing that.
And Andy, final question for you. Thoughts on appropriate flat fee to cover the admin and interest costs that come with an additional repayment holiday?
Yeah, I'm thinking it's going to be around £200, but we may just look at staggering that with regards to the size of the loan, because quite clear £200 admin fee and interest fee for a very small deal is probably out of line. So I think the average will be around £200. It will be published and we'll let you know within the next 24 hours.
This is not a profit generator for us. It's really just to cover our costs that are still incurred during this payment holiday period, where we're still paying interest to our wholesale funders. There's an administrative cost, and also to recognise the fact we didn't charge any fee or any increased interest during any first payment holiday wave. So that's really what that flat fee is all about.
There is also, sadly, Josh, just the element of we've had a number of customers where if they thought they'd have to pay a fee, they wouldn't have taken a loan, and that's seems a little unfair to me. So it'll be a little bit of deterrent to those sort of people. Yeah,
and it's a big part of how the mortgage industry are now messaging around payment holidays there, that this is not a free holiday. So I think it's important that people know that. That's all the questions we've had. Thank you very much. That's really helpful, and we'll send around the slides and further materials by email to you all on the back of this. As I said earlier, we will be ready to go live later this week. We have a genuine desire to use the scheme to ramp up the funding we can provide to SMEs, particularly those who have been impacted, particularly by COVID-19. And as partners, we look forward to working with you on this journey. Thank you very much for taking the time to listen to us today.